So, good morning, everyone. This is our second lecture for the Uniform System of Accounts. So just to recap what we did last week, we looked at the key departments of a hotel operation, and then we understood the frontline departments and what are the back-end departments, and that will come in handy today. And then we did a fun, like a very basic P&L, profit or loss statement, where we looked at income or revenue, and then expenses, and we looked at gross profit and profitability and on so on. And then we discussed from year on year how the performance has been, if you can recall, right? We did that exercise last week. So today, what we're going to do is we're going to look at the Usali based profit or loss statement, which is a bit more detailed than what we did last week, right? You will see different layers coming in. So we'll look at all those things today, right? So you can see the screen. The PowerPoint presentation is clearly visible. The first page,
yes, sir.
at least. All right, good. Right, so this is what we did last week. Sorry, excuse me. There's another, we did case study 1, which I shared with you last week. There's another similar case study 2, which I thought we will not do here because we have already done case study 1. And case study 2, I will send it to you via WhatsApp. And then you can do it at home and see whether you are comfortable with it. And if not, you can call me back or whatever, and then discuss whatever the issues that you have, because it's very, very similar to case study 1, okay? Right. So now, what we are going to do today is, like I said, we are now going to look at the Usali based the Uniform System of Accounts or Lodging Industry based P&L. So a couple of things to note here. The latest version that is out there for now, at least freely available for us to review or view, is the Usali 11th edition. If you just searched on the internet after my class last week, you would have found the 11th edition, the PDF freely available that can be downloaded. I have it myself. And then if you want, I think one of the students actually requested, I will share it with you all. But 11th edition is out. There is a 12th edition also, but the PDF, unfortunately, is not available for download still, right? So don't worry about that. We'll go with the 11th edition. And another thing to note is that Usali 11th edition, the profit or loss statement that is under Usali 11th edition is a bit different to what is appearing in your study text. We'll look at that difference as well, okay? What is appearing in your study text? You would have got the study text from CHFM, am I correct? For certificate level?
Yes. Yes.
Right. So there is a Usali based profit or loss statement given in that, which is a bit different to what is there in the Usali 11th edition. So what I will teach you is the Usali 11th edition because that is the most relevant in my view, right? And that is a bit more detailed than what is appearing in a study text. So you have to keep note on that, okay? The other thing to note is that some of the things that I discuss at class are not there in the study text. Therefore, you are free to take notes of the important points, right? The important points, you are free to take notes. I will not dictate the notes, but if it is an important point, I will repeat that. So if I repeat a particular point, that means it's very important, and therefore you can note it down on your notebooks. Because again, if you look at your textbook, there are certain information that will not be there in the textbooks that I discuss at class. Okay? All clear? All clear, guys?
Yes, sir.
Righto. Here we go. We'll first look at the page number page number 57 of your study text, right? So let me just access that. Yeah. Page number 57 of your study text. Share that with you. It sharing. Hey, give me a minute. Okay, I don't know whether it's visible or not. Do you see the P&L on screen? The profit or loss statement or uniform system of accounts for hotel industry? Do you see that? Uh,
Not yet, sir.
Not yet. This is wait. I'm trying to share the screen, but the bloody thing is not sharing. Hmm. Give me a minute. Okay, I will have to relog. I will log out and log in again. Okay. Am I back? Can you hear me? Hello.
Yes, sir.
Right. Sorry for that interruption. So as I was saying, page number 27 of your study text, I'm going to refer to that now, and then I'm going to just briefly show you what's there. Um, Give me a minute, my PC had to be open. Right, I hope you see this on screen. Right? It's visible on screen, correct? The study text.
Yes, sir.
Right. So what is shown here is a very basic profit or loss statement based on the uniform system of accounts. Only thing is that this is a bit outdated now. And then I thought, okay, let's not look at this, but we will refer to the uniform system, the 11th edition. So we will not refer to this. So make a note of that. This is not the format that we are going to study today. Right. And then we are referring to directly the uniform system of accounts, the 11th edition. Now, you see on screen the uniform system of accounts for the logic industry 11th edition. Is it visible?
Yes, sir.
Okay, so this is the one that is available. I think one of the students have shared the 12th edition, but those are the changes only, I think. But um, as I'm informed, the 12th edition is effective from 1st January 2026, but we don't really need to worry too much because that's not uh, really mandate to use Usali here. Right. And now what I'm going to show you is the same profit or loss statement based on the new Usali, okay? And that is what we're going to follow for the rest of our studies. So if you read this Usali document, all the explanations are given in detail. So if you are really interested, you can read these statements, okay? Right. Here we go. What we are going to refer to in our studies is the summary operating statement, and it says for owners, right? Um, don't get too complicated here. I don't want to complicate life too much. There are two statements for owners and for operators, right? Some hotels operate where the owners actually give the license or the management to another company. So the operation is done by a different company. The owners of the company is different. So for such scenarios only, these two statements are available, owners and operators. But I'm not going to complicate your life too much at this particular level. So we will just refer to the owner statement, meaning that we are assuming that whatever the profit or loss statement that we are going to do is for a company which owns and runs the hotel by themselves. Okay. Right. And another thing is coming. What's wrong with this? Okay. Now, so if you take from the top, I'm just going to give you a brief explanation of what you're seeing on screen. If you see from the top, we had the period, that is from which period to which period we are looking at. When we looked at the previous case study, we referred to this period as 23, 24 or 24, 25. That is a year basically um, from April to March, right? So that is the period specification. And you see the current period and the year to date. Current period meaning, if you want, it can be the month that you're referring to. Say, if you're preparing the statements for the month of November, then what is the November? And then year to date will be the cumulative from April to November, for example, right? Don't worry too much about it. Then we have the actual results, the forecast or the budget, and the prior year. We always have a comparator, right? So last time when we looked at the statement, we had the actual and the prior year actual, right? So now we have an additional column, the budget. What is the annual plan or the budget? So we make comparisons against the budget or the last year. So that is why it's here, right? As we go on, we will look at this in further, so don't worry too much. Then we have some indicators here, rooms available, rooms sold, occupancy, ADR, RevPAR, TrevPAR. We'll talk about it later, right? And then some organizations put more than this, right? FMB indicators are also put here, right? And then certain other information also can be put here. So this is not exactly a rule. It can be customized according to the hotels or the businesses need. Okay, right. Now here comes the important part: the basic P&L structure of the Usali system. Right. Here we go. Now, if you can recall, in a P&L you have the revenue and the expenses, and then the profit. All what you can see here is the same thing, but now we have different layers inside. We have several layers inside. So now we're going to dissect those layers and understand what they mean. Starting with the revenue. Starting with the revenue, right? Starting with the revenue. We start with the operating revenue. Operating revenue. Now, the operating revenue of a hotel is basically the revenue that is generated from the frontline departments. If you can recall my first lecture, I told you that there are certain frontline departments which makes revenue, and there are certain back office departments or uh, back end departments which doesn't generate revenue but actually supports the revenue generating departments. So what I'm referring to here is the frontline departments. So what are the frontline departments you can recall from the last week lecture? Can someone tell me? What are the frontline departments?
Front office,
Hmm? Front office, yes.
housekeeping,
Sorry.
housekeeping,
Yes, housekeeping, front office. Front office and housekeeping go together. I told you that it's normally referred to as the rooms department, right? They are in charge of the. So the first item that you see here is basically the revenue generated from our rooms. How many rooms do you sell at what rate? And there you go, the rooms revenue. And this rooms revenue is generated mainly from the two front-end departments, which is basically front office and housekeeping. They're the ones who are selling the rooms. Okay, so the rooms department. Then we have another frontline department, which is the food and beverage department. Food and beverage department. They also generate sales, no? It's a frontline department. So last week I said front and food and beverage department can include restaurants, then it can include banquet operations like weddings and so on, events, right? And then it can include catering. It can include delivery and so on. So what is the revenue generated from these operations? It goes under food and beverage revenue. Then we have the other operating departments. The other operating departments are none other than the mine operating departments. Remember the mine operating departments I spoke to you last week? Mine operating departments, remember? What are the mine operating departments of a hotel? Who can recall?
Excursion.
Spa. Yes.
Excursion.
Sorry?
Excursion.
Excursions. Yes, excursions. Excursions like, uh, nature hikes and all the trekking and all those things that you take the guests from the hotel. Then you can have things like laundry. Then you can have things like, what else? What else can you have? Spa, excursion. So these are basically revenue generating and they will have their own expense as well. Then sometimes telephones, telecommunication, right? Some hotels charge for the telephone calls and so on. If those are charged and the hotel generates an income, then it becomes a mine operating department. Remember, I told you mine operating departments generate a revenue, and whilst they're using resources and incurring expenses, but they incur those expenses to generate revenue. So that is what a mine operating department is. So like I said, spa, different excursions, right? Excursions that are provided by the hotel, the laundry operation, they charge the guest for the laundry. And then of course they do incur expenses to do that laundry. And then, like I said, telephone and telecommunication systems, right? If you charge the guest for Wi-Fi, then it becomes a mine operating department under telecommunication and systems. If you're charging, right? What else is there for mine operating departments? Can you think of? Hmm? What else? Nothing? Sometimes valet parking, if charged to the guest, then it becomes a revenue generating department. And therefore it's considered as a mine operating department. So all these are mine operating departments which contribute to revenue. So the revenue generated from these MODs or mine operating departments are captured under other operated departments. Okay. Then we have miscellaneous income as well. Those are minor incomes that are generated from other activities of the business. We'll look at it in detail as we go further on. I'm not going to harp on it too much. And then we have the total operating revenue. So this part is the revenue part of the P&L that we are looking at. Revenue, right? Is it clear up to now? Guys, is it clear up to now? Hello?
Yes, sir.
Revenue. Then I spoke to you about these expenses being split up to cost of sales and overheads, if you can recall my last week's lecture. Now, these cost of sales or direct expenses, as some may call it, are the expenses that are incurred by the frontline departments to provide their service to generate income. So in the Usali, it's referred to as departmental expenses. Departmental expenses, here we go. So this is basically the direct expenses or the cost of sales. Cost of sales. So what are these expenses? The expenses that are incurred by the rooms department. So when we say rooms department, it is the expenses that are incurred by the housekeeping and front office departments. Housekeeping and front office departments. The rooms expenses. Then we have the food and beverage expenses. That is the expense that are incurred by the food and beverage operations of the hotel. So which includes the kitchen and the outlets as well, right? Kitchens are also included here, right? Then the other operated departments, meaning the expenses that are incurred by none other than the MODs, right? The expenses that are incurred by the MODs to generate their revenue. So altogether, the other departmental expenses will make up the cost of sales of the P&L. Okay. So if you have noticed by now, the reason why I looked at the departmentalization at the very first class is because this P&L that we are looking at today is flowing down from that departmentalization. So as you can see, right? So now we looked at the cost of sales or the direct expenses. Cost of sales. Any questions up to now? Any questions up to now? All clear or not clear? What is the situation? One says okay. I hope okay. Tilina says okay. Harsha's good. How about Nuini? Prabuddha is okay. Shiranta and Nuini, I hope you're okay. If not, please let me know. Nuini is okay. Great. Lovely. So now let's refer back to our P&L. Now we looked at the revenue. We looked at the cost of sales or the direct expenses. These are mainly related to the frontline departments, right? Frontliners, front-end departments. Then we have the total departmental profit, aka otherwise known as the gross profit. We learned about the gross profit last time. So these are interchangeable names that are used by different disciplines. So you can we normally refer to as gross profit or the gross profit or loss. So here it's referred to as departmental profit. Okay, fine. Then I spoke to you about overheads, overhead expenses. Sorry, these expenses are normally incurred by the backenders, the backend operations. So as you can see, here it is referred to as undistributed operating expenses. Undistributed operating expenses. Why is it called undistributed operating expenses? Is because these expenses are not apportioned to a specific department because they service all the departments, rooms, food and beverage, the other operating departments. Everybody is serviced by these backenders. So it's called undistributed operating expenses. So we have administration and general, the first line. We have something called information and telecommunication systems. Now, earlier I said information and telecommunication systems, if charged, it becomes a minor operating department. However, if this service is not charged, if the Wi-Fi is free or the telephone lines communication is free, then that becomes an overhead expense for the hotel because you don't earn an income, you just incur an expense to service the hotel. So then it becomes an overhead expense. Okay. Don't worry. In the coming weeks, we will go deep dive into each line item and understand what are the line items, what are the specific characteristics or what are the specific things that are included in these line items. Okay, don't worry too much. So today the objective is just to show you the face of the P&L. Okay. Then we have sales and marketing expenses, the expenses that are incurred for marketing and promotion. Then we have property operation and maintenance. Now, what is that? That is basically the repair and maintenance expenses as we commonly refer to as in Sri Lanka, right? Repair and maintenance expenses. Repair and maintenance expenses. Right? Repair and maintenance expenses of a hotel. Right? Property operation and maintenance, repair and maintenance. Then we have utilities. Now for utilities in the Usali and commonly in the hotel industry, we use a term called HLP. Who can tell me what HLP stands for? Who can tell me what HLP stands for? Hello? I'm sure you would have heard this term before. Anyone? What does HLP stand for? Does anyone know? So HLP stands for heat, light, and power expenses. Heat, light, and power expenses. So when you talk about heat, light, and power expenses, what is included in this heat, light, and power expenses? Cost like electricity. Costs like fuel for heating and so on. For boilers, you use fuel. Water are the main things that go into HLP or heat, light, and power, or otherwise known as utilities expenses. All right. Any questions up to now? Hello? Is it clear or is it not clear? I don't know. Is it?
Clear, sir.
Right, great. So just to recap, undistributed operating expenses, also known as the overheads, the expenses that are incurred by the backenders or the backend departments, administration and general, information and technology systems, if they are not charged to the guests, the sales, marketing, property and operations and maintenance, that is repair and maintenance, utilities, or otherwise known as heat, light, and power, which includes electricity, fuel, and water, and so on. So these are the overhead expenses. Overhead expenses, right? Now, we have some other layers also given in this Usali PNL, okay? Now, once you get the gross operating profit and the undistributed operating expenses, you get something called the gross operating profit. The gross operating profit. I think somebody questioned regarding the gross operating profit. So this is what the gross operating profit is all about. Gross profit divided minus the undistributed operating expenses will give you the gross operating profit of a hotel. Okay. Gross operating profit of a hotel. Then we have something called some additional layers coming in here, right? Listen carefully. We have something called the management fee. Can someone tell me what can the management fee represent? What is the nature of a management fee? So most hotel companies will have a management fee that is paid to a managing agent. The hotel will have a contract with a managing agent who will manage the hotel on behalf of the hotel management, right? So there will be a fee that will be paid to this managing agent, and that fee is called the management fees, right? That fee is called the management fees. So again, the hotel is managed by a managing agent on behalf of the hotel management. The fee that is paid from the hotel to this managing agent is called a management fee. So when we go line by line and deep dive into these line items, we'll understand how the management fees are basically contracted generally, and then how we calculate the management fee and how we make payments for the management fees, right? So for now, just remember that this is a payment that is made to the managing agent for managing the hotel on behalf of the hotel management. Okay. After deducting the management fee from the GOP, you get something called the net profit, net operating income or expenses. Income before non-operating income and expenses. Okay. Now don't listen very carefully. Now there are additional layers that are coming in, so you need to pay attention. Okay. So we looked at the GOP. Now we had something called the management fee coming in, and then after deducting the management fee from the GOP, you get something called the income before non-operating income and expenses. Income before non-operating income and expenses. Income before non-operating income and expenses. Okay. So that is just GOP minus management fee. Then you see this line, non-operating income and expenses. Now, these are the expenses that are non-operational. Non-operational. It doesn't really relate to the operation of the hotel. Okay. Like what? There can be certain incomes are not operational. I will talk about this in detail when we go into deep dives, but I will not give you much information now because you get confused otherwise. Okay. Non-operating income, then we have rent or lease payments. Because like I said, rent or lease payments are paid for the spaces that we occupy to run the business. Maybe we are on rent, for which we need to pay a rent, or we may need to do a lease payment for the space that we occupy. We are leased out. So those expenses are going under rent. Now, this is not related to the operation of the hotel, right? These are non-operating expenses. Property and other taxes, like what? As you know, if you're occupying a building, you have to pay rates to the municipality. For example, rates. In Sinhala, we call it Varipa number, I think. Rates. Every year you have to pay this. So expenses like that are captured under non-operating expenses. Insurance, whether you operate the hotel or not, for the building that you have and the furniture and all those things you have, you need to insure these assets, and therefore you need to incur a insurance premium cost. So that insurance premium cost is a non-operational expense, which is categorized under this. And then we have other. If it is non-operating expense, then will get captured under this, right? Non-operating expenses or income. Okay, so that is an additional layer that has come in from last week, right? Last week we didn't discuss non-operating income, income or expense. Now there's an additional layer, non-operating income or expenses, right? So what do you have? Non-operating income, rent or lease expense, and the insurance of the assets that we have insured, the premium and others, right? So we have the non-operating expenses. And then we have the total non-operating income and expenses. Then we have something called the earnings before interest, taxes, depreciation, and amortization. Earnings before interest, taxes, depreciation, and amortization, or otherwise known as EBITDA. Now, I'm sure this terminology you would have heard before. Hands up who has heard this EBITDA terminology before? Right. Who else? Tilina has heard. Who else had heard the EBITDA before? Earnings before interest, tax, depreciation, and amortization. It is a very, very important indicator of the performance of a business unit, not only for hotels. Even if you see publications that are going out now, you would have seen, right? If you follow financial news, there are companies who publish their financial results on social platforms. Every quarter, especially listed entities will publish their financial results for the quarter. So they will refer to the EBITDA as the main performance indicator, right? So this is what EBITDA is all about, right? This is what EBITDA is all about, the one that I showed you, okay? So nobody else has heard about EBITDA before except for Tilina. Is that right? How about Nuvini, Prabodha, Shiranta, Harsha, Nuan? Never heard about EBITDA? Okay. Anyway, now you know what EBITDA is. After EBITDA, so this is EBITDA, and then after EBITDA, you have another section coming below that, which is the interest, depreciation, and amortization, right? For now, just refer to this, not think too much about it. But interest, depreciation, amortization, expenses. Interest mean the finance cost. You would have borrowed something from the bank, borrowed money from the bank to run your business. So you will pay an interest to this bank. So interest cost or the finance cost is what is captured under interest. Depreciation is basically the depreciation of your depreciation of your fixed assets, property, plant, and equipment. Amortization is also very similar, but this is for intangible assets, right? When you go into understanding this financial statements and financial reporting standards, you will get to learn this in detail, this amortization, depreciation, property, plant, and equipment, and all those things. I won't go into that length in this subject because you do have a separate subject looking into these areas. Okay. So just for now, know that there is another section for interest, depreciation, and amortization, which is coming after EBITDA. Then you have the total interest, depreciation, and amortization, and then the net of all these is called the net profit before income and taxes, also known as PBT, profit before tax. Profit before tax. Net income before income taxes. Net income before income taxes. Profit before tax. Right? I'm sure everybody has heard about the profit before tax. Right? And that is, again, a very, very important indicator for the business because this will actually give you the end result of all the business activities that you have done, and whether the business is profitable or not is indicated by the profit before income or tax. Then after PBT, to profit before tax, you have income taxes, which you pay on your profitability. You have to pay taxes to the government based on your profitability. So that is what you call income taxes. And you deduct the taxes, income taxes from the profit before tax, and then you get the net result, which is the profit after tax. Profit after tax. Here it's referred to as net income. Here, what I refer to it as profit after tax. Okay, profit after tax. So again, just to recap, we had the revenue, we had the cost of sales, we went into gross profit, then we have the overhead expenses, then we had the gross operating profit, then we had something called the management fee. After management fee, we had the non-operating income and expenses, non-operating income and expenses like the rent, the insurance, the property taxes, and so on. And then we have the earnings before interest, tax, and amortization. After that, we have the depreciation and amortization and the finance cost or the interest expenses. And then we go on to the profit before tax, the income taxes, and then finally the profit after tax. Okay. Is it clear? Nuvini says no. What is not clear for you? Nuwan says yes. Who else understood? Harsha says yes. Okay. Nuvini. Okay. Nuvini, you just type your problem. Tilina, yes. Prabhuda, yes. Okay. Nuvini. It's clear. It's clear, sir. Okay. Okay. Good. Nuvini is clear. Now, to understand this further, of course, we are not still deep diving. We will do it starting from next week. But to understand this P&L structure a bit better and to get it registered in your head, I'm going to give you a case study. That is case study 3. Okay. Let me share this. How am I going to share this now? That is through. Just give me a minute. I'm just trying to figure out how to. Give me a minute. I think I can. Give me a minute. I'm just trying to figure out how to share this file with you. Okay. Let me do this. I will share it via WhatsApp so that everyone can download it. I think that will be easier for me. Just give me a minute. Give me 5 minutes. Right. I have shared a document with the WhatsApp group. Can just see whether you can download that. Have you all received it? Have you all received it or not? Huh? Did you receive the WhatsApp message?
I received, sir.
All right. Okay. Can you open it? Just see whether you can open it. Can open? No? Okay. I believe it's openable. If it is not, just let me know. But in the meantime, we are going to look at this PNL. We'll do it together since this is just the first time we are going to do this, and some of you may not be very familiar with this PNS and so on. So I will do it together with you, right? So this is a very simple exercise just to get this PNL structure registered in your head. Now, as you can see on screen, the case study 3, you can see on screen, correct? Yes or no?
Yes, sir.
Right, let's read it together. Lialtra is a five-star hotel operating in Colombo. Lialtra is a five-star hotel operating in Colombo. The financial performance of the hotel for the years 24-25 and 23-24 were as follows. Okay. Financial years 24-25, 23-24. So when I say financial years, you know now in Sri Lanka and most of the world, when you say financial year 24-25 is from April to March. So what are the results? We have all figures in millions. First of all, note that. Room revenue we have, F&B revenue, room expenses, F&B expenses, other operating department revenue, that is the main operating departments, rental and other income, information and telecommunication systems cost, looks like they're not charging, other operating department cost, sales and marketing cost, administration and general cost, repair and maintenance, utilities, HLP, rental costs, property and other taxes like the rates, depreciation and amortization, insurance, management fees, income tax, and finance cost. Okay. Required. Prepare a P&L based on Usali. Discuss the financial performance of the hotel based on your P&L. Okay. Now, something that you need to include in your P&L is, if you refer back to your Usali P&L, now you know the structure, but I want you to add certain things to this P&L structure. Believe I'm sharing the screen now. Sorry, my mic was off. I don't know how long it was off. Now, guys, what I was saying was, does anyone have access to Excel, Microsoft Excel? Hello, can you hear me?
Yes, sir.
Yes, sir.
Can-
All right, okay, great. So if you do not have access, I suggest you get access because it's easy and faster. So let's do the PNL now. And if you do have any questions along the way, can you please stop me and then ask, okay? Okay, let's do it together. Now I'm going to share this Excel sheet with you. Right. I believe the Excel sheet that I have shown on screen is visible. If not visible, please let me know. Okay, so this is the information that we have got from the case study, which I shared with you a couple of minutes ago. Then we looked at room revenue and so on, the information that we have. So I will give you about 5-10 minutes, just cook up a P&L and put these figures in place. And remember, right? And remember, this is the format that I'm looking for, okay? So you have at the top like this, the years and the percentage. The percentage again is basically the line item absolute value divided by the total revenue. Even room expenses divided by the total revenue is what is represented by the percentage, okay? For both years. So I want the format like what is visible here, okay? I'll give you about 10 minutes. Can you quickly cook up the PNL and we'll discuss the results, okay? Sounds good? Yes? No? Hello? Hello?
Yes, sir.
Right, okay. Just a note, there will be certain line items that are not there, which we in the PNL structure, would have told you certain things are there, but not appearing here. So don't worry about them. Just keep it blank, okay? Are you all done or do you need more time? Hello? Are you all done? Are we ready for discussion or do we need more time? Okay, we can have maybe 5 minutes or 4 minutes more. 4 minutes more. Finish things off. Okay, I think that's adequate time. Well, if you are not finished it, then you can still follow um, the screen and then get your things in order. So it's just a matter of clubbing or structuring these expenses and the revenue line items as per the Usali P&L structure, right? That is all what we're doing. So let's look at the P&L structure that I have done and see whether you are in line. And if you're not, and if you don't understand something, please let me know so that we can clarify that. Okay. So you can see the screen. I have shown the Excel sheet here and the PNL that I was requesting you all to do. I hope it is visible on screen. If it is not, let me know. Right. So are we ready to go, guys, or not? Hello. Okay. Yeah, Nuwan is okay. Can I get a thumbs up from the others as well? Are we ready to move? Right, Harsh is a thumbs up. Harsh is a go. Nuini, Shiranta, Tedina. What about y'all? Tedina is good to go. Right. I think Nuini and Shiranta. Okay, Shiranta is good to go. Nuini, are you okay?
Yes.
Nuini has raised a hand. Do you have a question? Okay, while she's typing, I will go into the PNL structure. So as I said, I wanted these columns to be there at the top. So we have the 24, 25, and then the percentage, that is the particular line item represented as a percentage of total revenue. So I believe that you basically put those columns in. And then at the top, you have to give what is the LKR in millions so that the reader will understand the numbers are in millions, right? Okay. So referring to the Usali P&L, we're starting with the operating revenue of the hotel, operating revenue. We have the room revenue, F&B revenue, other operating department revenue, and rental and other income, right? Rental and other income. So earlier we saw another word for this, which is the miscellaneous income or other operating department. It gives the same thing, right? Rental and other incomes also can be categorized under operating revenue. Okay, so I hope you got the structure right. Room revenue, F&B revenue, other operating departmental revenue, also known as minor operating departments, and rental and other income also have categorized under other operating revenue. Of course, you didn't see this line appearing under the Usali PNS structure, which is a standardized structure, but then there will be variations like this that you will come across when you work across different organizations, different countries. So you have to club it in the most appropriate place, right? So the total operating revenue then would be 3.1 million. Am I right? No, sorry, 3 billion, 3.1 billion. Am I right? And then the last year, 23-24, would have been 2.4 billion. Correct or not correct? Yes, no? Did you understand this?
The rental and other income is correct.
Yeah, so rental and other income, you can categorize under other operating, operating revenue. That's what I said. So rental and other income, meaning there can be incomes like if you're operating a hotel premises, right? There can be shop spaces that you have given out as rent. So you will earn a rent from that shop spaces. Of course, the shop is operated by a shop operator, so they're a tenant, and you will earn a rental income. The hotel will earn a rental income. So if these shop spaces are actually, is it the hotel property, hotel loan property, then you can take it as operating revenue because the hotel is the one who is operating these spaces. Although you have leased it out to some other person, rent it out to some other person, you still earn a rental income. So you can categorize that as operating revenue. Okay. So when we go into detail, we'll understand a bit more further of the nature of this rental and other income, right? For now, just note that this rental or like other income are from the hotel's operation. It is part of the operation of the hotel. That's why it's called under operating revenue. Okay. Meaning that it is owned by the hotel and they operate this space. Hope that is clear. When we go in and deep
Yes.
dive, we will understand it further. Okay. For now, don't think about it too much, but know that it is rental space or that the hotel has given, which the hotel has owned. Okay, right, fine. Then we go on to the departmental expenses, which comprises of the room expenses, F&B expenses, then the other operating departmental expenses, meaning the mine operating department expenses. And then you finally have the total cost of sales. So here we have the departmental expenses, total departmental expenses, also known as what? The cost of sales. And that will be 325 million versus last year or 23-24, 153 million. So all these expense line items and revenue line items, you can see that I have given a percentage. Now this percentage will come in handy when it comes to explaining these results or describing or discussing these results uh, in the second section of this case study, right? Then you have the gross profit or total departmental income as per the Usali, or as we call it, the gross profit. 2.7 billion, that is a 90% gross profit, and 2.3 billion, which is a 94. So as you can see, 94 has gone down to 90%. Any questions up to the gross profit? All clear? If you have any questions, you have to stop me and ask. Then we have the undistributed operating expenses, administration and general, sales and marketing. Then I said the information and telecommunication system. So that means this particular business is not charging for this service. So it is incurred as an expense. Repair and maintenance cost, then utilities or HLP cost is also given. And the total undistributed expenses given as 700 million. I think that is correct, which is 23% of the total revenue in 24-25. In 23-24, it had been 19%, which is 468 million. And then you have the gross operating profit or the GOP, which is 2 billion. And last 23-24, it was 1.8 billion. And this as percentage of revenue is given as 67% for 24-25. And for 23-24, it's given as 75%. Now, the gross operating profit divided by the total revenue as a percentage is called the GOP margin. Okay, GOP margin. Just note that down as well. So what you have calculated here is the GOP margin. Everything clear up to GOP margin? Any disparities? All agree, not agreed? This says yes. How about the others? You're good to go. Okay, I think we are good to go. Then we have the management fee, which is 72 million and then 60 million for the 23-24, 2% of revenue. Then we have the non-operating income and expenses, right? Then rental cost, property taxes, and insurance we have. I think some of you would have got confused with that rental. What is that? Rental and other income being factored in here, I suppose, right? So when we go into depth and understand this rental and other income, and then the hotel ownership and then so on, and then what comes under income as non-operating income, we will understand further where it fits into. So I think some of you would have got confused there, but don't worry too much. For now, let's say non-operating income and expenses, rental cost, operating and insurance cost. So there is no income. Okay. For this case study, there's no income. Okay. Then we have the total non-operating income and expenses, 170 million and so on. And you can see the percentages. And then we have our EBITDA, the earnings before interest, tax, depreciation, and amortization, which is 1.8 billion, which is a 59%. Again, when EBITDA is shown as a percentage of total revenue, it is the EBITDA margin. It is called the EBITDA margin. So what you have calculated here is the EBITDA margin. Okay. EBITDA margin 59%. 23-24, the EBITDA margin was 66%. So it has decreased, no? Right. Then we have the total interest, depreciation, and amortization cost, which is finance cost, and then the depreciation and amortization cost is given. And then you finally have the NPBT, or net profit before tax. Net profit before tax. Some may call it net income also, but it's net profit before tax. And then we have the income taxes. So again, income taxes are the taxes that you pay on the profitability of the company to the government. Uh, so this tax is different to the property and other taxes, right? Taxes here, the property and other taxes clubbed under operating, non-operating expenses are the taxes that are not based on profitability or revenue. Okay. What you pay based on revenue or profitability is what you call income taxes here. Pay, and you have finally the profit after tax. Profit after tax. 1.2 billion versus 1.1 billion. So in terms of profit after tax, it has increased. Any questions up to here? Did you all get this answer? Do you agree or not agree? Hello?
Agreed, sir.
Hello? Hello? Agreed.
Agreed, sir.
Right. What about the others? Luini, Harsha, Nuwa, Shiranta. Are you all okay? What's that? Tilina? It is Tilina.
Okay, sir. Yes.
Right. If you do not agree, or if you do have discrepancies, we can clear that out before we leave this. Huh?
So we can't hear you.
In terms of financial profit in India, right? Got disconnected again. Am I back or not back? I think I'm back. Look at this Excel sheet or the P&L. What can you guys tell me has happened to this hotel organization? Was better? Is the performance bad? Give me some pointers. Hello?
Revenue increased.
Yes, revenue has increased. Yes, good. So that will be your first point when you are discussing this, no? So you will comment on let's say the overall revenue, right? The overall and the first point, the change in overall, right? The change in overall revenue. And if you want to discuss even further, you can say how the room revenue has increased 1.5 to 1.8 and so on, right? Uh, Even if you want to go further, you can say that the F&B revenue contribution to the hotel property has actually become more significant. How can I say that? 39% of the total revenue has been contributed by the F&B revenue. Again, 39% of the total revenue has been contributed by the F&B revenue. 23-24, 36% only has given by the F&B revenue, and rooms has contributed 61. So the contribution from F&B revenue to the total revenue composition of 24-25 has increased. So F&B has gained more significance here. And room, on the other hand, has gone down in terms of contribution as a percentage to the overall component. Okay. So all these analyses are very, very important when it comes to decision making and maybe trying to understand the behavior of the expenses, right? So I won't go into that detail now, but you need to understand how to look at this information in a meaningful way. Okay, that is why I'm trying to talk about this. For certificate level, of course, for answer, if you comment on how the operating revenue has increased or decreased, that will be adequate, right? Now, what about departmental expenses? Now, there's something interesting here. Who can tell me about comment on the departmental expenses or cost of sales? There's something uh, there that you can really spot if you really look at it. What can you say? Of course, there's a change in cost of sales, right? Cost of sales has increased from 153 to 325 million. Yes. Excuse me. Yes, that is right. But then what about the cost of sales percentage of revenue? Now, that is something concerning if you are the business owner, if you're the general manager of this hotel, you will be concerned here because in 23-24, 6% of the revenue was your cost of sales. But for 24-25, this cost of sales percentage has gone up to 10%, which means that cost of sales has taken a bigger chunk of your revenue, meaning that your profitability will be deteriorated. Okay, look at this again. The cost of sales from 6% has gone to 10% of your revenue. So the cost of sales is taking out a bigger chunk of your revenue in 24-25. Now that comment has to come in here. And if you look at in detail, you will see that the culprit for this is the rooms expenses. Rooms expenses has been 2% of total revenue in 23-24, which has now become 6% of total revenue in 24-25. So that is the reason why the cost of sales also has moved in the same way. If you look at F&B expenses and other operating department expenses, it is same percentage of revenue. But rooms expenses is taking a bigger chunk out of the total revenue. And that is the reason why the cost of sales is also increasing. So that comment has to come in. Why the cost of sales has been increased like this? Any questions on that point? Any questions up the point?
No, sir, clear.
Okay. I I hope the others are also good. And then you comment on the gross profit or the gross profit margin, the gross profit and the gross profit margin. So what has happened here? In absolute terms, of course, the gross profit is increasing. That is good because your revenue is increasing. Of course, the cost of sales are also increased, but the revenue increase is a bit more than the cost of sales increase. Therefore, you will still have, in absolute terms, the gross profit has increased, which is good. However, again, as a hotel manager, general manager, or the owner of the hotel, you will be still concerned about the margins here. 94% of the revenue was the GP for 23-24, but 24-25, the GP margin has dipped to 90%, right? The GP margin has dipped, which means that the profitability, although in absolute terms has increased, the efficiency of the business has actually deteriorated. Why? It goes back to point number 2. The cost of sales has increased by 4% there. That is the reason why the GP is dropping from 94 to 90. Okay. Because the cost of sales is taking a bigger chunk of the revenue, a 4% more chunk of the revenue in 24-25, the gross profit has decreased by the same amount from 23-24 to 25, 24-25, right? Is that clear up to that point? How about Nuan or Nuvini? Good? Nuvini? Harsha, good? Nuvini? Shiranta, good? Tilina, good? Okay, Nuvini says clear. Tilina, how are you? Well done. Thank you. Now let's go down further. Undistributed operating expenses. Let's see what has happened. I will just jump down to the total undistributed expenses. So you can see 700 million, 460. So you can have the fourth point for undistributed expenses. What has happened in absolute terms? And you can comment on the percentage also, percentage of revenue. So what has happened here? From 19% to 23%. Look at what has happened. Undistributed expenses from overall revenue 23-24 was 19%, which has gone to 23%. Again, the undistributed expenses are taking a bigger chunk out of the total revenue, which is, of course, detrimental to your profitability. The efficiency of the business has actually declined a bit. Okay. So when you're commenting, you will talk about the absolute value, of course, which has increased from 468 to 700. But most importantly, as a percentage of revenue, it has increased from 19% to 23%. Now, why is that happening? If somebody asks, if the general manager is asking, why is my undistributed expenses increasing from 19 to 23, you have a clear answer here. What has increased? What are the contributors to that problem? Can someone tell me? Can someone tell me where the problem is occurring from? Look at the P&L very carefully. Look at the undistributed expenses line by line. HLP is one, yes, good. What is the other one? Maintenance cost. Correct. So, main repair and maintenance cost has increased from 4% to 6% of revenue, which is a 2% increase, and HLP 8% to 10%, which is another 2%. So overall, an additional 4% of the total revenue has been absorbed by repair and maintenance cost and HLP, which has led to the undistributed expenses moving up from 19 to 23%. And therefore, the gross operating profit, your fifth point will be on the gross operating profit. The gross operating profit, of course, in absolute terms has increased, which is good, but you have to comment on the GOP margin that has deteriorated from 75% to 67%. So this is a combined effect of the GP margin dropping and, of course, the undistributed expenses also moving from 19 to 23%, right? It's a combined effect. So this is a combined effect of this, the GP margin moving down, as well as the undistributed expenses percentage moving up. And therefore, the GP margin is dropping. Hope that is clear. Then the management fees there, there's nothing much to comment on there. Then the non-operating income and expenses are there, the rental, the property taxes, and so on. Mostly it has remained fixed, so you don't have to really comment on that, especially. And then what the next comment should be is on your EBITDA and the EBITDA margin. EBITDA and the EBITDA margin, you have to comment. Of course, in terms of absolute value, EBITDA has improved, which is good. But in terms of EBITDA margin, 66% has moved down to 59%. It's 66% to 59%, which is again a result of the GP margin and the undistributed expenses moving up. That's an additional point. If you want, you can see that the non-operating income and expenses as a percentage of revenue, 5% versus 7% minus. So it has actually decreased. That is because even though the revenue has increased at the top line, right? You can see that the revenue has increased, right? Even though that has happened, these expenses have remained static. It has not changed. That is why as a percentage, it has moved down. Okay. That is an additional point if you want. Okay, I hope it is clear until EBITDA line. Then we have the finance cost or the interest cost, depreciation, which is very straightforward. And then we have the net profit before tax. So the seventh point that you will have to bring in is, of course, the change in the NPBT and the NPBT margin. So absolute value, it has increased, good. But in terms of percentages, it has decreased again because of the discussions that we had earlier. You don't need to repeat that. That is obvious. Then we have income taxes, which has moved up. That's fine. And then the eighth comment will be on your change in profit after tax and the PAT margin. PAT margin. Right? So same story, same story. Right? So if you give these 8 points, that will be more than adequate for this answer. And this will bring out the most important elements of the interpretation of this P&L, and that will feed into the decision-making process of the hotel. Okay. Do you understand this or do you need further explanation? What is the situation?
All clear, sir.
Good. Nuvini, Nuan, Harsha, Chiranta, what about y'all? Nuan, good. Harsha, good. Nuvini, Chiranta. Chiranta is good. Just need one confirmation more from Nuvini. Nuvini, are you there? Hello. Okay, I hope it's okay. Again, if you do have any question, you can always contact me and then get it cleared. Let me see whether there are any questions. Maintenance. Okay. Sir, can you explain the EBITDA point again? Think. Is the EBITDA clear, Nuini, or you want an explanation? This was
Can you
posted.
explain again, please?
EBITDA.
Yes.
Right. So EBITDA, again, the earnings before interest, tax, and depreciation and amortization, right? Earnings before interest, tax, depreciation, and amortization. So, do you have any specific question, Nuvini, or are you overall, do you want explanation? Or do you have any specific confusion?
I know you told about that the reason to be deduct that amount by compare with the revenue.
Yeah. So you're asking why it is going from 66% to 59%, correct?
Yes.
So it is basically a combined reason of the GP margin dropping. We discussed that. And then again, the non-operating income and expenses as sorry, no, the undistributed expenses have moved up from 19% to 23%. Like what we discussed for uh, the rest of hotel operating profit. Yeah. Yeah, so basically it is basically the undistributed expenses moving up from 19% to 23%. That is one reason. And the GP margin is dropping from 94 to 90%. Sorry, from what is that? Yeah, 94 to 90%. Those two reasons. I think you would have got confused where I spoke about this non-operating income expenses 7% to 5%. That is because these expenses, the non-operating income and expenses, mainly the expenses have remained static despite the revenue increasing. That is why you see 7%, 5% going down. But the reason, again, for EBITDA drop is the GP drop and the non-distributed expenses moving up. Is that clear or not clear?
Yes, sir. Thank you.
Righto. Okay, then. So that is just to understand the P&L structure as per the Usali. Again, make a point that we are referring to the Usali PDF here, not the study text, because the study text P&L is a very basic one and it's outdated. That is why I decided to refer directly to the Usali P&L. So when you're referring to it, when you're studying, please make a note of that. Okay, so from next week onwards, we will be deep diving into each line item, room revenue, what is there, how it is made up of, what are the channels and so on, and what are the characteristics and so on. And each line item, likewise, we are going to deep dive and then understand what is actually the nature of these expenses. And then we'll have a better understanding of what, again, these profit or these expense line items or revenue expenses actually represent. Right? Good. Any questions? If there are no questions, we will meet next week, same time. All good? I believe all good. Okay, then. Thank you very much for joining the lecture. I will meet you next week.
Thank you, sir.
Thank you, sir.